Welcome back to Iron Financial, everyone. Listen, if you're tuning in today, you aren't looking for standard, watered-down financial fluff. You're here to forge a stronger portfolio. You're here to cut through the market weakness and build wealth that can withstand maximum macroeconomic pressure. So go ahead and hit that subscribe button right now because today we are firing up the heavy machinery. Our mission is an in-depth explainer and a brutal stress test of the structural durability of Mastercard's Q1 2026 earnings release, which just dropped on April 30, 2026.
That's exactly right. We aren't just reading the rosy headlines today, folks. We are taking an absolute sledgehammer to this balance sheet, the income statement, and the forward guidance. We're going to see exactly what bends, what breaks, and most importantly, what holds strong under pressure.
Because look, here is the central debate we need to settle for every single retail and institutional investor joining us today. Is Mastercard's massive, double-digit top-line growth a bulletproof fortress? Or are we starting to see macro cross-border slowdowns, those heavy winds of a tightening global economy, quietly chipping away at the foundation? I mean, it's really easy to look at a stock chart going up and to the right, but it is much, much harder to spot the micro fractures in the concrete before they become a massive problem.
Absolutely. Hit the nail on the head. And as the lead analyst here, I'll tell you right out of the gate, the initial print looks like solid titanium. Seriously, let's look at the sheer structural load this company is carrying right now and how it's actually performing under maximum pressure.
Just look at this headline metric right here, $8,398 million in net revenue for the first quarter. Let's put that into perspective. That's nearly $8.4 billion in a single 3-month period. That is a massive 16% year-over-year growth on a GAAP basis and an incredibly robust 12% on a currency-neutral basis. The structural integrity here is just undeniable. Plus, adjusted net income came in at a staggering $4,103 million, which drove an adjusted diluted earnings per share beat of $4.60 against the Street's $4.41 estimate. Listen, you simply do not put up those kinds of numbers if your core economic engine is sputtering. That EPS is up 23% year-over-year, or 18% currency neutral. It's a powerhouse.
Okay, I hear you. I'll concede the top line beat. Look, $8.39 billion is a ton of weight to move in a single quarter, no doubt about it. But revenue doesn't mean a whole lot if the operational costs of running the machine are eating away at your final yield, right?
Well, let's take a look at the tempered strength of the bottom line then. Adjusted operating income came in at an ironclad $5,109 million. That's up 19% year-over-year and 13% currency neutral. But honestly, here is the number that should have every single growth-focused investor paying very close attention: an adjusted operating margin of 60.8%. Think about that. They actually expanded their margin by 1.5 percentage points year-over-year compared to Q1 2025's 59.3%. You want to talk about a bulletproof moat? A 60.8% operating margin is the pure textbook definition of a structural monopoly. They process the transaction, they take their cut, and nearly 2/3 of it drops straight down to the operating bottom line.
Hold on a second. Let's not get totally blinded by the shiny exterior of these adjusted non-GAAP metrics. I want to hunt for cracks in the armor here. As a retail investor, I always get incredibly suspicious when management aggressively points me to the adjusted column. Let's scrutinize the gap between GAAP and non-GAAP for a minute. I'm seeing a $202 million pre-tax restructuring charge recorded in Q1 2026. What exactly is that all about? Are they tearing down load-bearing walls because the original floor plan just isn't working anymore? And what about this $66 million in net pre-tax losses on equity investments? To me, that says market volatility is hitting their balance sheet in ways they can't entirely control.
That's a totally fair push, but let's contextualize the stress. That $202 million restructuring charge, that is management purposefully taking a wrecking ball to outdated internal divisions to free up capital and reinvest it for long-term growth opportunities. They are actively reinforcing the structure, not abandoning it. And the $66 million equity loss? Honestly, it's unrealized fair market value adjustments. It's basically noise in the grand scheme of things. That core operating margin of 60.8% remains the true measure of their metallic resilience.
Okay, moving on to Section 1, volume and network drivers. Let's transition from those shiny exterior metrics to the heavy lifting being done by the network's underlying volume. Because to truly understand Mastercard's durability, you have to understand the sheer unadulterated volume of capital flowing through its pipes. We are talking about $2.703 trillion in worldwide gross dollar volume in just 3 months. Trillion, with a T.
That's a 7% growth in local currency. But let's dissect the regional architecture that's actually supporting this massive load.
Right, let's do that. Because when you break it down, the United States is actually looking like a sluggish, aging foundation. U.S. gross dollar volume was $795 billion. That's up only 4%. That tells me the American consumer is seriously feeling the macroeconomic fatigue. You just can't rely on 4% domestic growth forever and expect double-digit revenue growth to hold up under that kind of weight.
Actually, scratch that. It's exactly the beauty of their diversified global footprint. Sure, the US might be growing at a tempered 4%, but look at the aggressive, heavy machinery of the rest of world segment. $1,908 billion in volume, growing at a massive 9%. The international markets are the steel beams supporting that overall 7% global volume growth.
They don't even need the U.S. to run hot if the rest of the world is carrying the load this effectively.
Okay, I see the volume, but let's debate the network's operational efficiency. Switched transactions grew by 9%, hitting 43.8 billion transactions across their massive base of 3.695 billion total cards. That is solid throughput, for sure. But look at the operational friction here. Adjusted operating expenses increased by a heavier 11% on a GAAP basis, landing at $3,289 million. Your expenses are literally growing faster than your transaction volume. That is structural fatigue. When it costs you 11% more just to process 9% more transactions, the machine is losing its operational leverage.
Now wait, you have to look at the currency-neutral numbers there to see the true engineering behind this. On a currency-neutral basis, those operating expenses were actually up 9%, which exactly matches the 9% growth in switched transactions. The structural leverage is perfectly balanced.
Well, I'm still not letting management off the hook that easily. Let's zero in on that expense burden a bit more. When you scrutinize that $3,289 million total, it reveals exactly where the bloat is coming from. General and administrative costs are a massive $2,837 million. That's up 12% gap. Meanwhile, advertising and marketing, completely flat at $153 million. So they aren't even spending to acquire the end consumer. They are suffering from corporate bloat in G&A. I mean, how much heavy lifting can those margins really take if administrative costs just keep compounding at 12% a year?
See, you're looking at it wrong. That G&A line isn't just a bunch of executives in expensive suits. It's vital personnel, it's core technology infrastructure, and most importantly, it's the intense cybersecurity required to protect 43.8 billion global transactions. In the digital age, G&A is simply the non-negotiable cost of reinforcing the vault.
Which brings us to Section 2, Engines and Expense Burdens. Let's shift this stress test toward the dual revenue engines driving this entire enterprise.
We need to measure these engines against the mounting friction of customer incentives, because Mastercard is no longer just a simple toll booth on the financial highway. This is, without a doubt, the most critical structural shift in Mastercard's business model. Let's examine the two core pillars of revenue. The legacy payment network revenue sits at $4,948 million, growing at a respectable 12% gap, or 8% currency neutral. But look at the new structural reinforcement here. Value-added services and solutions brought in $3,450 million. That's up a massive 22% gap and 18% currency neutral. Value-added services, which includes their elite fraud prevention, data analytics, and consulting arms, is becoming the true high-margin growth engine. It's fundamentally insulating the company from relying purely on base transaction volume.
Okay, I have to admit, 22% growth in value-added services is a genuinely impressive alloy to add to the structure. But let's talk about the friction I mentioned earlier. Let's talk about the raw, unfiltered cost of keeping the banks happy so they actually keep issuing those Mastercard-branded cards in the first place.
Boom. Look at this number, $5,639 million in rebates and incentives. And that number is growing at 23% year over year. 23%. That is vastly outpacing the 12% growth of the core payment network revenue itself. They had to pay out over $5.5 billion in a single quarter just to incentivize banks and merchants to route volume through their network. So I have to ask the hard question, is Mastercard paying? All right, Section 3, the April Early Warning Indicator. We promised you guys we'd fully stress test this earnings report, and that means looking for real, hidden vulnerabilities. And we've actually uncovered a potential microfracture in the foundation, buried deep in the April month-to-date data.
Oh, this is where the structural fatigue really starts to show. Let's brutally contrast the robust Q1 numbers with this newly released April 28th update. In Q1, we saw strong 13% cross-border volume growth overall, right? Driven by intra-Europe up 14% and other cross-border up 12%. but look closely at the April 28th month-to-date update. Cross-border travel volume, which by the way is the absolute most lucrative high-yielding transaction type for Mastercard, decelerated sharply to a mere 2% growth. Just 2%, that is down from 8% in Q1 and down massively from 11% in Q4 of 2025. The travel boom that practically fueled this stock post-pandemic is showing some very serious signs of stalling out.
We really need to go deep on the implications here. As the skeptic in the room, I'm looking at that 2% cross-border travel growth, and I'm seeing pure macroeconomic exhaustion. The everyday consumer has run out of excess savings, inflation remains ridiculously sticky, and that expensive international vacation, it's the very first thing getting cut from the household budget. If cross-border travel volume continues to decelerate like this, the yield on total cross-border assessments is going to compress. That moat is shrinking, plain and simple.
I hear the alarm bells, I really do, but let's aggressively defend the metallic resilience of the overall portfolio for a second. Yes, cross-border travel slowed to 2% in April, but look right next to it at cross-border card not present, excluding travel, that metric held up at a staggering 17% growth in April. So people might be taking fewer international flights, sure, but they are still heavily engaging in global e-commerce. Overall cross-border volume was still up 9% in April. The foundation is shifting, yes, but it is certainly not crumbling. The diversification between travel and global e-commerce is doing exactly the job it was engineered to do.
Finally, Section 4, 2026 Outlook and Guidance Revision. This brings us to the final phase of our stress test. Let's look at the blueprint for the rest of the year.
We've looked at the Q1 performance and the April warning indicators. Now we evaluate management's revised structural blueprint for the remainder of 2026. Despite that April travel softening we just talked about, management remains highly confident in their architecture. They updated their full-year GAAP net revenue guidance, revising it firmly to the high end of low double digits to low teens. That is an incredibly strong full-year posture. And contrast that with their specific Q2 forecast. They expect low double-digit revenue growth against high single-digit operating expenses. So they are actively projecting that revenue growth will re-accelerate past expense growth in the second quarter, expanding those ironclad margins even further. I mean, that is a bold projection. If they can actually keep operating expense growth contained in the high single digits while pulling low double-digit revenue, all concede the machine is highly efficient. But honestly, they are walking a tightrope here. If that April travel deceleration bleeds into May and June, that low double-digit revenue target for Q2 is going to be under extreme structural stress.
Which brings us to the ultimate question, the iron financial verdict. Is Mastercard a rock-solid buy right now or a structural wait? Let's weigh the facts side by side. On one side of the scale, you have an immense, world-class 60.8% adjusted operating margin, 22% GAAP growth in value-added services, and a massive EPS beat. The core structural durability here is just elite. For a long-term portfolio, this stock is forged in iron. I say it's a solid buy.
And on the other side of the scale, I'm weighing the structural fatigue. You have a 23% compounding burden in rebates and incentives, literally costing them over $5.6 billion a quarter just to keep their market share. You have sluggish 4% U.S. volume growth and a sharp, alarming drop to 2% growth in cross-border travel for April. The foundation is simply too expensive to maintain at these current valuations. I'm calling it a structural wait. Let the macro weakness hit the stock price a bit more and look for a much better entry point.
Two sides of the iron coin, folks, and that's exactly why we build these explainers, to stress test the numbers so you can make the hard decisions for your own portfolio. But it leaves us with one final structural question for you to chew on. If the global consumer is finally tapping out on travel, is Mastercard's massive margin enough to shield it from a true macroeconomic earthquake? Keep your portfolio strong, keep your analysis sharper, and we'll see you in the Forge next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional